So hello, today's topic is going to be an introduction into depreciation, more specifically provision for depreciation, which has to do with accounting for non-current assets. In introducing provision for depreciation, we need to revise and we need to know exactly what are we dealing with. Non-current assets. What are non-current assets? So assets are used to generate income over a period of time. For the non-current assets, these are assets that have a useful life of greater than 1 year, meaning that they are used for more than 1 year. That is the intention when we purchase the non-current asset. That means that if it is not being used, therefore it is not an asset. So this is the very definition of an asset. It must be used. And notice, once again, the emphasis is on used. So some examples, revision. We have some examples of the non-current assets that you are familiar with, like land and buildings, machinery, vehicles, fixtures and fittings, furniture, so on and so on. Once it is used for more than 1 year, it is considered a non-current asset. So that is the intention. Once again, just remember, emphasis is on used. What is the non-current asset used for? So what is the intention of purchasing these non-current assets? It is to be used to generate revenue and profits over a long period of time. So just making a plug there for the mask. The mask is only an asset to you if you use it. So that means asset used. So because the business uses the asset deteriorates or decreases in value over its useful life. The asset deteriorates in value due to its use through wear and tear, which is the main reason for, or the main cause of depreciation for us in CSEC. So because of it's being used, as you saw the car driving and driving and driving and driving, that means that it will suffer from wear and tear, basically. And that means that it would reduce in the value. It was previously a certain value. You purchased it for a certain amount of money, but because you are using it over time, that value will be reduced. And that is what we are calling depreciation. So what is depreciation? Depreciation is the reduction in the value of the non-current asset due to use in the business. The more you use it, or the longer you use it, is the more it is going to reduce in value. So at the end of the period, the end of its useful life, it will be worth less than previously when you purchased it. So why do we have to account for depreciation? Because we do not account for appreciation. So land is an asset that does not depreciate, but it appreciates. However, we are not to account for that increase in value. But we do, however, have to account for the decrease in the value of the non-current assets. Why? There are two rules in accounting: matching concept, also known as the accrual concept. And this rule, basically, we are required to match the depreciation expense with the income generated by using the non-current asset. What is that saying? Why do we use an asset? To generate revenue. But in using that asset to generate that revenue, we are, of course, depreciating the value of that asset. That has to be accounted for. So the income that is generated by using the car, for example, as you saw there, that income has to be matched with the depreciation or the reduction in the value of the car, because we are using it during that period to generate the revenue. The second rule or concept that requires us to account for depreciation would be what we call the prudence concept, also known as conservatism. The prudence concept states that we are not to ever overstate our profits. If we do not account for depreciation expense, because remember, expenses decrease or reduce your profits. If we do not account for that depreciation expense, then we will be overstating profits when we calculate profits in the income statement. The same thing for your assets. If we do not account for the depreciation or the reduction in the value of the non-current asset in the balance sheet, then we will basically be overstating our value for non-current assets in the balance sheet. So our users will see an overstatement in the value of our non-current assets, and then they will not be making an informed decision. They need to see that these non-current assets, because it is being used to generate the income and the profits, that it is reducing in value. So that must be accounted for as stated with the prudence concept. So how do we account for depreciation? Well, it is an estimate because we do not know the exact value that it is being reduced by. So we therefore do have to make an estimation because we do have to account for it based on the matching and the prudence concepts. So because of that estimation, we have two methods that you will learn in CSEC, two methods to calculating an estimated annual depreciation. So your depreciation expense for the year that will go into the income statement, we have two methods that we can use. And those two methods would be called the straight line method and the reducing balance method. So the two methods, because of the matching principle that states that for each non-current asset, the depreciation expense incurred for the period must be estimated and charged to the income statement, we therefore have to use one of two methods to calculate that estimated annual depreciation expense that has been incurred because of use. And the two methods are the straight line method and the reducing balance method. Now remember, once again, the emphasis is on depreciation being an estimate. So it has to be reliable, it has to be objective. These two methods, straight line method, basically the assumption is that the non-current asset depreciates over time at the same rate. So the depreciation expense is the same annually. If you calculate or estimate your depreciation as $5,000, then for every year over the useful life of the non-current asset, depreciation expense will be $5,000 in the income statement for the year. For the reducing balance method, however, just like the name says, reducing meaning it decreases. This assumption is that you use up most of your, the value of your non-current assets at the beginning when it is new. When you've just gotten it, the first few years, you get more out of it. So you get more out of it in terms of the usage, more wear and tear. And then as it gets older, the value will decrease. So this is the assumption. So that is when you use this method, assuming that it is not an equal depreciation or reduction in the value because of usage. You can just think of any old non-current asset, like an old car, and you will see that you get less value from that older vehicle than you did when it was newer. So that is basically what the reducing balance method recognizes and accounts for. So these are the two methods that you're going to be learning, methods of calculating or estimating depreciation, and that will be done in our next lesson.